All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and/or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. John, what is our topic today?
I think a very appropriate one that we deal with a lot in our day-to-day analysis, but one that I think impacts people a lot more than they expect, and that is the impact that we get, for which we get our information. So it's often the financial media, or sometimes just from a random person on social media. But I think it's very important for us to discuss how we get our information and how we synthesize what's useful, what's appropriate, and some of the distortions that it can create, which you'd be surprised actually happens quite frequently when we pull from sources that are unreliable or inconsistent, or we pull on themes that aren't necessarily the priority of the masses. I think one thing is important to remember for this conversation, and generally, the markets are not the perspective of a single person. It's the perspective in the prioritization of the entire financial system and all the markets participants and all the capital that they represent. So I think that probably would make a lot of sense to most people that hear it. But in practice, and the expectations that I see people often put on, the release of a CPI or what have you, it can be colored by their expectations or sometimes their want, their desire for it to have a substantial market impact, just because they want to see some volatility or they want to avoid volatility. But that's not how the market works. It will dictate and determine how market moving that the news is going to be, whether it's scheduled or unscheduled. And the interpretation that it gets is not always the one that is the most, let's say, appropriate. It's not going to be a cold, hard review of the facts and putting into context about what the prioritization of the big picture is. It's shaded by speculation. It is driven by assumptions and hope and fear and greed across the spectrum. And that's something that I think really needs to be taken into consideration. So, Matt, to you, how do you feel most markets are collectively absorbing their information?
I would say in many cases it's through financial media or through social media, which is I think what you're getting at here, in that in many cases people aren't as focused on the raw economic data with its flaws, with its advantages, but instead are interpreting that through a filter. And I think it was Charlie Munger that said, show me the incentives and I'll show you the outcome. It's important to remember that the incentives of financial media outlets are to get eyeballs on them. So if we see jobs report that comes out at 40,000 jobs when 30,000 was expected, instead of saying, well, yeah, it's probably about as expected, there's a wide range here, it's not anything that changes the underlying market. Instead, you're going to read jobs market beats for the first time in X months, and that therefore is more likely to get your eyeballs on it. So they're fulfilling their incentives, but it might not be in your best interest, versus having this more humility driven approach and understanding some of the flaws and the wide range of outcomes when you're trying to anticipate something like how many jobs were created in the last month in an economy as large and diverse as the US or really any country. So I think by keeping those incentives in mind, I always like to go to the raw economic data, ideally understanding some of its ranges of outcomes and trends, and using that as an anchor in the storm of headlines that you're inevitably going to get inundated with if you're interacting with markets or even just listening to any radio show or TV show anytime. There's always that misaligned incentive there, and by sticking as close as you can to the pure economic data, I think that's how you stand the best chance of interpreting what's actually happening and making ultimately successful decisions with your trading and investing. So that's the first place I'd like to take that. And John, I'm happy for any thoughts that you have there.
Yeah, you're exactly right on the financial news, and perhaps we're part of this machine, this beast, because we know that everyone is going to be talking about non-farm payrolls if it is meaningful in the anticipation, but also on the actual release itself. So what do people often want to click on? They want to click on the most bombastic, extreme headline that they see. And then you have these old listicle formats. I don't think they're as common as they used to be. The 10 reasons why this non-farm payrolls is going to just blow up the market. Those types of headlines were very popular. They're less so now, but you still get that shade of skew, and that skew can be taken over to the markets as well and drive that expectation. But I'm totally aligned. I think we want to see the known event risk, and we want to be able to know what's coming out. This is for known event risk. This is not necessarily known for, or you can't portend the unknown. So reactive news is going to be much more difficult to sort through, but it's going to be difficult for the market to really assess for itself how much this new news matters. But for the known, we have the benefit of actually having an economic calendar or a global macro calendar. We can see how important are these, and you can have shortcuts. I mean, this is what we're here for. We're here to establish what themes are most important, and thereby what event risk that is scheduled or expected to come out is going to touch these themes, and thereby that's where the anticipation of volatility can reasonably be set, and we can get away from just the constant flow of pure headlines on a reactive basis, or looking for those extreme interpretations of everything. And I mean, there's nothing more disappointing than going to the market and expecting a big piece of event risk, and you're watching something like the S&P 500, or watching the Euro USD, and you expect a mammoth move because you read some article or some Twitter thread that suggested that this upcoming event was going to be just the most dramatic driver of price action. You prepare for, you develop a strategy around it. The event or the news crosses the wires, and nothing, just nothing. It's a dead market, and that's, again, this is a complex system of many different people's perspectives, and they have to determine, is this important to all of us, and is this event risk really motivating or moving that theme? And that's not the easiest thing to do. And I mean, we have situations where anticipation and buildup and speculative outlook is going to start skewing those views. In fact, I think a great example, if you want to take it, Matt, is the anticipation of the lifting of the US government shutdown and what that led in terms of expectation. But what did it mean in terms of realization as we move through it and we actually see it being lifted?
Yeah, I did a full analysis video at sort of the start of the government shutdown, and essentially one of the big takeaways was that the economic impact is not as severe as perhaps you might think from one of the largest employers in the country kind of going offline, and those of the people who work there in some cases either being on hiatus or not getting paid. However, a lot of the temporary economic impacts come back around when people receive back pay and book travel that they've delayed and such. So that might be an example of what we were talking about, where when you look at the raw data, you can have a better perspective on what will actually happen. More to the context of this week, as we record this, it's Wednesday, the 12th of November, 2025. It looks likely that the US government will reopen. And this is right about on the timeline, even though it's the longest in history, the timeline that prediction market traders, for example, have been focused on for weeks and weeks now. So it was something that was always going to happen. We have seen a bit of a market reaction, I would say. We've got a bit of risk on trade so far this week, but that's something that could be anticipated, and the actual act of reopening the government certainly will have an impact on the economy. But it's important to remember that markets are always forward looking. So as soon as that became the very likely outcome over the weekend, markets immediately adjusted to that, and as a result, I wouldn't expect necessarily whenever Trump signs the order to reopen the government that markets will have waited till then to react. It's sort of
Mhm.
old news by the time the outcome becomes very likely, and instead, I think some of the implications could be we'll get some of that data that was delayed, and maybe that reflects a poorer labor market, for example, that some of the private data was suggesting as well. So it's important to remember that markets are always forward looking. They're anticipating what's going to happen in the future. And well, you may have read bombastic headlines about how disruption of the busiest travel days of the year is possible. Ultimately, it's again getting back to this idea of incentives that politicians don't want that because that threatens their jobs. So they were able to get it sorted, and traders, in my view at least, have sort of moved on from that. So it's big news. You're going to see a lot of headlines on it, but having that perspective, as you talked about, John, of the underlying themes driving the economy. This was more of a temporary speed bump, perhaps, rather than something that was going to derail the themes that are driving the stock market and risk appetite more broadly. Is that how you interpret it, or did I miss anything from your
For
perspective?
sure, for sure. And I mean, obviously, we're in the thick of it, so it's kind of like askew. We know the details and all the big picture and how influential it's been, and then subsequently it's ebbed back. But I mean, you boil it down to its core concepts, and turns into one of the usual aphorisms that we have for markets. It's the buy the rumor, sell the news, or
Mm-hmm.
sell the rumor, buy the news kind of situation. Where this week really has been a big build up from the equity markets in terms of expecting that shutdown to end. And then when the news actually crosses the wires, again, it is headlines, anticipatory headlines, and speculative orientation of the markets themselves, trying to price in what the reasonable expectations are for the future of the market and those important drivers. It plays out not as you would expect in a purely academic or
Mm-hmm.
textbook way. So it's really important that we take all this information with a grain of salt and try to find how to distill it to its most important parts for whether you're a short-term trader or a long-term investor, because you don't want to get shaken out of something that doesn't turn out to be as problematic for your positioning as you would expect otherwise. So from something like the pure headlines, if you're looking at Google or you're looking at like a Bloomberg terminal or what have you, reading those and reading them into context, but then also using tools. I mean, if you want tips and tricks, you can go to trends.google.com and see what's most important and thematically for search across the markets. I have here kind of a pre-populated tariffs, interest rates, economy. If I were to add in government shutdown, um, and of course, this is a global search over the past 90 days, for those that don't see it, it dwarfs everything else because we know this theme in particular right now is probably more important. But something like this can help you filter that top theme, prioritize event risk, and be less dependent upon the interpretations of one news outlet, and certainly for Twitter handles, because I know a lot of people seek out information from well-known personalities, whether they be in a social media platform or they might be on financial news shows. Nothing against them. We do the same thing, but always put it into context. Try to appreciate the big picture and try to prioritize with how the market would prioritize. If you keep expecting the market to have a 5 point swing and it's consistently just moving 0.5%, you're misaligned, and you're misaligned to, I think, what the market is really driving towards. And that's an important thing to avoid. Any other tips and tricks you would add to this, Matt?
I would underscore yours. You know, if you're fighting the market, that's something that you're never going to win, regardless of how much money you have. For broad liquid markets, the market sentiment and flow of capital is always going to dwarf any individual trader. So I think just sticking with price can be just a good anchor to avoid getting caught on the wrong side of the market and stubbornly sticking to a prior that's been proven wrong. One other tip or trick I might have, and it's difficult to do in practice, but I think it's very valuable, is just exposing yourself to independent thinkers who
Mm.
often disagree with you, and understanding their point of view. You might, again, disagree with it, but by giving it a fair chance and understanding at least what someone who might be bearish on a market that you're bullish on, or vice versa, or might think a certain event could be a game changer, whereas you've written it off, that can help you get a more well-rounded, holistic perspective on markets. And certainly I seek out people who are willing to change their mind. I think looking at someone who's a perma bear or a perma bull, maybe there's some value in that, but ultimately they're not going at the markets in a genuine way. So someone who says, hey, I thought this jobs report, to use the same example again, was going to be poor and reflect AI leading to people not having jobs. But if we see something that proves that wrong, I think it's actually a feather in their cap if they can say, oh, I was wrong here. This thesis isn't playing out. And now that's changed my perspective. So I think both trying to be one of those people and certainly following people who are independent thinkers who might disagree and are willing to admit they're wrong is one of the best ways that you can fight against these deep-seated psychological beliefs that we all have, that we want to be right, that we want to have strong opinions. But in markets, that can be very dangerous if it goes too far. So that would be one piece of advice I'd leave traders with.
That's a great tip. Great tip. All right. Thanks for tuning into the Trade Global Macro Podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcast. I'm John Kicklighter.
And I'm Matt Weller. Join us next week for more insights into the trends and events shaping the world's financial markets.